So when I look at the news and see $2 trillion is being injected into the economy, my overly simplistic model of the world is you did not create more goods, you didn't create more services, you just added more dollars chasing around those goods and services. So it seems apparent to me that inflation is obvious, but I'm told by several people that that's not the way to view the world. What do you think?
Well, it is not. The Federal Reserve undertook very similar programs to what they're doing now back after the great financial crisis in 2008 and 2009. It was called Quantitative Easing. And the Federal Reserve bought a large quantity of the federal debt. It was supposed to accelerate economic activity, lead to higher inflation, cause a collapse in the dollar, especially since the federal budget deficit was also simultaneously rising very rapidly. However, that's not the monetary. The monetary economics is very complicated. And the Fed can buy government securities, agency securities, but when the transaction clears, essentially what happens is the sellers of the Treasury debt give up, on average, a 7-year maturity obligation. And when this clears and goes through the banking system, the banks then have a deposit at the Federal Reserve, overnight deposit. So the principal effect is really just to lower the average maturity of the consolidated government balance sheet when you consider the Fed is a part of the U.S. government. The banks do have reserves, which they could convert into loans, and this would lead to an acceleration in the money supply. However, for that to happen, you've got to meet a lot of hurdles. Number one, the banks have to have the capital to put their reserves at risk. And they also have to be able to make a determination that putting those reserves at work in the form of lending, that the borrower is going to repay. And since they don't know for sure whether the borrowing is going to repay, they have to price in a risk premium that the borrower will default. And by the same token, the borrower has to make a rather complex decision as to whether they want to put their capital at risk by borrowing additional funds. Whether if by borrowing the funds, should they not be able to repay it, will that cause that firm to lose its viability, become bankrupt? So the bottom line is this. Debt is an increase in current spending in exchange for a decline in future spending. Take on debt, current spending goes up, future spending goes down, unless the future debt generates an income stream to repay principal and interest. If you generate income streams to repay principal and interest, it's all good. Unfortunately, the debt that we're taking on, while it's politically popular, humane, necessary because people are hurting, what we're basically doing is we're financing day-to-day living needs. We're keeping business afloat that would have otherwise failed. This does not generate an income stream to repay principal and interest. So I don't know if you ever studied economics, but one of the most important concepts is the production function, which says that the GDP, or our output, is determined by technology interacting with the three factors of production: land, labor, and capital. And if you overuse one of the factors of production, such as borrowed funds, initially GDP will rise. And if you continue to overuse that factor of production, GDP flattens out. And if you still overuse it, it turns down, diminishing returns. And what has happened is we've long since passed the point of diminishing returns. In the case of government debt, there's a lot of very serious econometric work that indicates that when government debt gets to about 50% of GDP, there's a deleterious impact on growth. Goes to 60, the deleterious effect is greater. The negative repercussions are greater at 70, 80, and 90. The econometric studies indicate that growth against trend is reduced by about a third. In other words, if you were growing at, let's say, 3% in real per capita terms, you'll only grow 2%. Now, we were at 107 before the coronavirus hit. And by the end of this year, we're going to have a government debt to GDP ratio of somewhere around 125 to 130%. Totally unprecedented. The diminishing returns is nonlinear. It's a parabola. You cannot think in linear terms. And a lot of people don't want to do that. They think this is business. This is accounting. It's not accounting. If I were a physicist and told you that you had to grapple with nonlinearities, you would say, okay, well, I understand that things can be elliptical or parabolic, but that's what happens. No, we have a lot of cases that have occurred historically, and if you pursue the high debt road, what happens is economies get weaker and weaker and weaker, and as the growth gets weaker, then you get disinflation, inflation falls to very low levels, and then eventually you get deflation.
What's the difference between disinflation and deflation?
Disinflation is when the inflation rate falls. Deflation is the point at which the falling inflation rate takes you through what's called the zero bound. In other words, you cross from some small degree of inflation to a situation where prices actually fall. And here's the difficulty that we have currently. We came into 2019 with the world $100 trillion more in debt than it ever was, heavily over indebted. And the global economy was doing very, very poorly, very poorly. Germany, Italy, Japan were either in recession or very close to it. China's economic growth in 2019 was the slowest in 29 years. And the only reason it was the lowest in 29 years is that's all the data they have. It was doing very poorly. And perhaps one of the best metrics of why the global economy was in such trouble is that in 2019, the volume of world trade declined by about 0.5%. And that's only the third annual decline in world trade volume since 1980. It happened during the deep recession of 82 and the deep recession of 2009. And historically, world trade volume grows faster than GDP. Normally, world trade volume grows at 5 and GDP at 2.5. And it's the globalization that pulls you forward. But last year, because of the problems of the global economy, world trade was declining. The coronavirus hit at a very inopportune time. Domestically, we were over indebted. All of the major economies of the world were extremely over indebted. The global economy was over indebted, and the emerging markets were over indebted. And so, what the world has been trying to do for a long time is to solve this indebtedness problem by taking on more debt. Now then we get hit by this event that comes out of left field. And what are we forced to do? We're forced to go further into debt. And so the steps that are being taken, while they're necessary, politically mandated, popular, they help people in dire times. What they're going to do is they're going to actually make the potential for economic growth much weaker. So as a consequence, once we contain the coronavirus, and I don't know when that will be, but when it's contained to a reasonable degree, we will get a sort of a pent-up demand recovery in economic activity, but it won't last very long. And then the economy will struggle domestically and globally. We're not going to have a V-shaped recovery. It's going to be very difficult because all this new debt that we're taking on is going to weigh on our ability to grow.